The fundamental stock price is based on really two factors: corporate earnings and interest rates. And now, where do actual prices go? They go wherever psychology drives them, above and below these fundamentals. But let's look at these two key fundamentals. And start off, this is a history of S&P earnings from the end of World War II until now. You can see this is a log chart, so a straight line means a constant rate of increase. And you can see that in the middle of these fluctuations, there's a constant rate of growth, and that growth is 6.5% per year. That's the long-term upward trend in earnings. And this is why the S&P over time has gone from like a value of 10 in the early 40s to a value of 5,700 today. It's been driven by this upward trend in earnings. You can also see that there seems to be a tendency, strong, I call it strong economic pressures, that whenever the earnings get out of line, either above or below, they tend to go back to that trend. Now, let me blow up this earnings chart just a little bit. So we look at the more recent period. You can see the fluctuations. You can see where earnings are today. They're, by this measure, they're 17% above the trend line. And by another measure, they're 30% above. I find this trend line so valuable that I use it as my main input into my stock market fundamental model. There's also the second factor, interest rates. You see, when interest rates are low, all assets, including stocks, are worth more. And when interest rates are high, all of those assets are worth less. So I believe you have to change the fundamental value of the stock market model to adjust for these interest rates. When you do that, here's what I end up with in terms of my stock market model. And this is, again, from the end of World War II. Interesting thing here is this spike in stock prices, and that was the dot-com boom at the end of the last century. At that point, stocks rose to the point where they were selling for more than twice their fundamental value based on my model. It's the most explosive rise in stock prices that we've seen. Interesting to me is when they came down with the crash, they only came down back to the fundamental. And what that tells me is that we should be very cautious when the stock market gets too high. Now again, let's blow up that chart to the most recent period. We see a couple of things. We see the financial crisis. Right before it, stocks were about 25, 30% higher than my estimate of the fundamental. With the financial crisis and the bankruptcies in 2008, stock prices fell, and they fell to about half of my estimate of fundamental value. This market was very cheap. But even though the stock market was very cheap, people now had an idea of how risky stocks could be. And so you might remember over the course of the past decade or so, again and again, people would be saying, the market's overvalued again, it's going to come crashing. But the model here shows that no, that wasn't true. That people's perception of risk was so great that the market stayed undervalued for more than a decade. It wasn't until the end of 2020, the beginning of 2021, when we finally got above the market's estimate of fundamental value. Now, at that time, I said, hey, we're in the exact opposite situation that we were in after the financial crisis. Here, people have an overly blown risk, a sense of risk of what's in the market. Now, after more than a decade of nothing but mostly upward moves in stock prices, people's psychology goes in the other direction. And my expectation was that we would be between fundamental value and somewhere above fundamental value until we have the next financial crisis. Where are we today? We're about 36, 37% above our fundamental value.